Imagine you're watching a chart. The price suddenly takes off, but your entry signal doesn't trigger until the move is practically over. The problem usually comes down to the default MACD setting, 12-26-9. Gerald Apple developed those numbers in the 1970s specifically to analyze weekly, long-term charts. When you take a tool calibrated for weeks and drop it onto a 1-minute or 5-minute day trading chart, you get severe signal lag. Mechanically, the 12 and 26 period moving averages require too many candles to calculate a crossover. The math moves too slowly to catch momentum shifts in real time. By the time that default setting finally flashes a confirmation signal, the bulk of the profitable price action has already happened. Relying blindly on those default settings for day trading guarantees delayed entries. You end up buying at the top of a spike or selling at the bottom. The intuitive fix most traders try is to floor the gas pedal. They accelerate the MACD settings down to 362 to force earlier entry signals. This flowchart maps what actually happens next. If you use the default 12-26-9, you get signal lag. But if you switch to a hyper-fast 362, the indicator tracks every minor price fluctuation. It turns standard market noise into actionable alerts. This creates the whipsaw effect. You get bombarded with rapid, alternating green and red triggers. You enter a trade, the market twitches, the indicator reverses, and you get stopped out for a loss. Calibrating the indicator's speed to your specific time frame is only half the battle. Surviving that increased speed requires a mandatory momentum filter to verify those signals. This comparison matrix breaks down the alternatives, starting with the 8-17-9 setting. Calibrated for 5 to 15-minute charts, the shorter look-back periods provide a faster crossover signal. It patches trends earlier, but the moving averages remain wide enough that the math ignores micro-fluctuations. Its primary limitation is sudden volatility. If a major news event hits and the price spikes violently, this setup will lag behind the initial breakout. It performs best in trending environments, like blue-chip stocks or major forex pairs, where the price action remains relatively stable. Intermediate day traders often find this the safest upgrade, as it sacrifices peak instantaneous speed to gain higher reliability. Moving to the next column, we have the 5-8-3 setting. This is engineered specifically for the 1-minute scalping environment. The benefit here is near-instant momentum triggers, highly effective during explosive market opens, like the London or New York sessions. But during low-volume hours, when the market moves sideways, 583 generates pure noise. You must add a second filter. Traders pair this MACD with a fast 7-period relative strength index, verifying that the momentum crossover is backed by real market strength. The 5-8-3 setting operates as a precision instrument, but it becomes a financial hazard if used without a secondary momentum check. Then there is the 3-6-2 setting. This is an ultra-extreme setup designed to react to momentum shifts in a mere 30 to 90 seconds. Backtests of this specific configuration prove that it underperforms the market unless the signals are explicitly confirmed by external data. The required filter here is volume. A 3-6-2 crossover should only be traded if accompanied by a volume spike at least 1.5 times the recent average. Without a surge in actual buy and sell orders, this ultra-fast MACD just reacts to the bid-ask spread. Even with volume confirmation, you must execute with ruthless stop losses. The 3-6-2 functions as a hypersensitive trigger, requiring active protection and precise execution to survive frequent false breaks. If we step back and look at the academic literature, we can see how these indicator combinations hold up when tested in high-frequency algorithmic models. The data shows a positive correlation. Adding technical indicators to machine learning models enhances downside protection and risk management. But look at this line chart. It maps a major mathematical flaw. These optimized models struggle severely with out-of-sample generalization. This is overfitting. A perfectly calibrated setting for today's volatile market fails spectacularly when the market shifts to a choppy regime. Academic data suggests that while high-frequency MACD setups can flag risk during short-lived inefficiencies, they struggle to provide sustainable predictive accuracy across different market regimes. This quadrant chart maps these exact trade-offs to your specific trading profile. Take the intermediate trader who cannot watch the screen constantly or who lacks the discipline for strict volume confirmation. Their profile plots right here, using the 8-17-9 setting on a 5-minute chart. This trader must avoid 1-minute charts entirely to protect capital, exchanging high-frequency opportunities for safety. On the opposite end, the highly active scalper trading high-beta crypto or NASDAQ opens maps to the fast 583 or 362 setups. Firmly, success requires accepting the exact trade-offs of your chosen quadrant. You cannot have scalper speed combined with swing trader reliability. That leads to a final trap. Many traders believe they can use minute-level MACD settings to accurately predict raw future returns. Treating technical indicators as predictive engines on micro timeframes is fighting the efficient market hypothesis. You are trying to capture pure market noise. The reality of day trading is that if you use fast settings, your win rate drops. You have to rely entirely on strict risk-to-reward ratios to stay profitable. The perfect MACD setting is a myth. Long-term profitability comes from matching your indicator's speed to the market's volatility and enforcing strict risk management when the indicator inevitably fails.